Well, greetings and welcome to the March 2025 Investment Strategy Brief. In this session, I want to get into how will DC policy shifts shape the markets. So let's jump in. Recall that in our outlook for 2025, which we published early in the year, we have a bunch of articles, but we did offer a forecast for the year, both for the economy and the markets, to be modestly positive. Now, as we've talked about before, we included in that some work around more tail scenarios, the bull case, which would be super positive, and the bear case, which would be a little more negative. And I just wanted to take a quick minute against this backdrop of what's going on in DC to talk about the bear case. Recall that when we've talked about this before, we've talked about different potential roadblocks to growth and a different sort of paths that we could go down. But at the heart of it, both of these tail scenarios are anchored in the effectiveness of change in DC. And one of the paths we talked about when it comes to the bear side of things was an erosion of animal spirits. So this was sort of predicated off the potential for either erratic shifts in policy and or poor communication, of course, potentially policy error, if you will, making too big of changes or changes that would impact things in a super negative way. But ultimately, where one way it would show itself is that people would sort of take a pause around the uncertainty, and maybe consumers would slow down their activity or businesses would slow down their activity. So the idea of animal spirits being softened a little bit as a result of this uncertainty. And so far, interestingly, that is sort of the one path that may be showing itself. It's still super early, but we'll get into some information, some data that shows us that people are just a little bit worried. Now, in the Outlook effort and some follow-on publications, we do give some airtime as well to the bull case. But today we're going to focus a little bit more on the bear case and some of the things going on. Now, what I do want to do to sort of set that stage is to get into some, not all, but some of the changes that are going on in DC, talk a little bit about what's happening, a little bit about who, from an investment perspective, or the country's perspective, who some of the winners might be, and where the risks might lie with these different changes. And so let's start with the idea that really in terms of where we are with the transition, people talk about a president's first 100 days as being quite significant. And President Trump for this second term is basically about halfway through that at this point, right? But the change has just been, broad and wide and deep. 89 executive orders. And again, the idea as a result of this is that there's some concern that people are worried about the uncertainty and it's dampening animal spirits, so it could lead to an economic slowdown, but maybe affecting the markets sort of real time. So as it relates to, topics I want to get into, let's start first with the idea of government restructuring and efficiency. So we know that the idea of the Department of Government Efficiency, or DOGE, was created with a goal of cutting wasteful spending and downsizing federal operations. And that, among other things, one of the positives for that is the idea that it's going to help fight against a big deficit. We have to get our debt under control, our budget under control. So the idea of methodically going through and looking for ways to cut spending really will contribute to that. Obviously, the potential risks include disruptions potentially to government services, maybe economic uncertainty that unfolds as a result of this, and any unintended, therefore, negative economic consequences. So again, this is a big focus we know for the administration. Next would be fiscal policy and taxation. So we also know that there's an intention to extend the 2017 tax cuts, probably add a few more tax cuts in there. And that, of course, will benefit individuals, small businesses, corporations more broadly, and probably investors in terms of being business friendly. And then ultimately, whatever industries have, sort of incentive to put money to work, that's probably a positive. Now, obviously, this works in the other direction. So lower revenue means that that's going to push the deficit higher, which is a headwind to improving that fiscal trajectory that we just talked about. So again, I think the spirit of this is to say, hey, that we know they're going to go for this, and it's that trade-off of sort of the positive benefits versus the budgetary implications. Now, next up would be trade and economic policies. And so here, of course, we know it's all about tariffs. We know there are tariffs imposed on Canada, Mexico, additional tariffs on China, this idea of tariffs in other places all around the world. And so that's been a real focus when it comes to worries, risks, right? The idea of this increasing cost, maybe slowing the economy, maybe increasing inflation, and ultimately, so that's something that's been in focus. Now, when we take a step back to sort of the economic policies and look at things like deregulation or going back to traditional energy, drilling more, pipeline approvals, et cetera, a rollback of climate regulation, all of that probably has, a positive impact on the business environment, certainly for traditional energy companies and companies like pipeline developers. But we do have to worry about, sort of any implications that might come from that. Of course, there will be talk about worries about the environment, things like that. And so, again, those are the risks that people are worried about. I think that's probably the thing to focus on, is the uncertainty that people see as a result. Now, next up, foreign policy and national security. So we know that President Trump has talked about wanting to help negotiate peace in the couple of wars that we're seeing, right? Russia, Ukraine, and then the situation with Israel Hamas, and it's rough going, right? There's discussions going on and pushback, and sort of it's been rough for sure, but it remains in focus. And I would say, kind of related to that is this idea of a refocus of our military back towards a warfighting position. Strength really is what the president's looking to do, and then overall just his commentary about American influence. And so obviously when it comes to things like infrastructure, or defense contractors, or businesses that might help rebuilding after a war, all that kind of thing, there will be different pockets of investment opportunity. But I think it's very important to focus on the risk. So we're obviously talking about change relative to global alliances and the global world order almost. And obviously that creates heightened geopolitical uncertainty. And we should expect, for example, China to sort of look for ways to take advantage of this and sort of strengthen ties with our sort of traditional historical allies. And so again, a lot going on as it relates to all this, and more we'll see in the future. Now, of course, there's immigration and border security. There's been much stricter enforcement, obviously an effort to deport folks that are here illegally, and just being more aggressive overall. Incrementally, businesses that may support those efforts can potentially benefit from it. But from an economic perspective, the things that people are worried about, the uncertainty to some degree relates to things like potential labor shortages in affected industries, and any other economic disruptions, and of course any humanitarian concerns. So this idea of immigration and border security is in focus as a result of all that. Now, I'm not digging into it in this session, but we know we're anticipating changes in areas like education, health and human services, the judiciary, like what kind of challenges when it comes to the judiciary and the legal system, even housing and urban development, or the sort of HUD, what goes on with that, if anything. And then this overarching question when it comes to things like artificial intelligence, specifically, and technology more broadly, exactly what kind of regulations should be in place as it relates to those activities. So that's just a little bit of what's going on in terms of the DC transition. But I would just reiterate that the most relevant thing for the economy and the markets is really this sort of sense of uncertainty, and it's causing potentially individuals to slow their spending, potentially businesses to slow their investment, and the market has been anticipating that. So we've seen increased volatility and a decline in the market, although it's recovered off that bounce down sort of 10% on the S&P 500, for example. So I wanted to talk about a couple other things as it relates to the some of the data we're seeing in the context of this DC transition. So for example, the University of Michigan Consumer Sentiment Index has fallen off a little bit. And you can see here that we've got sort of this level that's fallen down. But what's notable is we were able to get this data series broken up. It's actually by 3 buckets, but we've shown 2 of them. There's sort of independents, which tend to track the median reasonably closely. And then there's Republicans and Democrats. And what we can see is in the wake of the election, sort of the parties switched. And so basically, when it comes to this change, what we're seeing is that the sentiment for Republicans is much higher than Democrats. And so the Democrats are really sort of blue in the current environment. Republicans are generally optimistic. What's interesting is when we look at the blend, it looks like, as it relates to this survey, that there's a bit more Democrats than Republicans influencing the overall number, right? And so I think it's probably helpful to note that when it comes to folks that align with the Republican Party, they're actually pretty optimistic in the current environment. So that idea of polarization making its way into some of the soft data, is something we have to be mindful of. Now, another thing I'll mention is, hey, it's sort of commonly observed that when we look at the first year of a typical presidential term, essentially the stock market typically is positive. So this blue line is the average of all the first year terms, and then that other line, that's basically the full line is Trump's first year, his term. And his first year of his term, and then this light gray line going up and then coming down, and it's starting to recover a little bit. That's the S&P 500 in this current situation, right? So we'll see how this all plays out. It could move back higher. We kind of expect that it will, but overall, this decline, certainly up against Trump's first term, was notable. And it relates to the pace of change and the uncertainty that's been developing. Now, turning to the economy more broadly, we know that the economy has been on a positive trend growth line after the recovery from the pandemic. And when we look at the data, we do like to focus in on the consumer being 2/3 of the economy. And what we've seen is the second half of 2024 was a very strong period for the consumer, retail sales, for example. And what we've seen is a softening of that off the back of that strength, right? A most recent print, honestly, was a little bit positive, but there was some data that was a little bit negative. But again, it's against that strong second half of 2024. So generally, the way I think about it is the number has bounced around mostly above the line. That's the sort of the indicating positive growth. Now, as it relates to the consumer, I've mentioned sentiment, I've mentioned confidence, and interestingly, the sentiment measures, which we just went over with a little bit of a leaning towards Democrats in that survey, are a little bit negative relative to their sort of neutral view. But the data that we're seeing from the Conference Board on Confidence, it's actually a little bit above the long-term average. So a little bit mixed soft data when it comes to the consumer. In any event, we know that the consumer sees a headwind of debt and the increase in cost of debt, which we've talked about, even with that against, but supported by a strong labor market. Now, small businesses, we've seen sort of a similar thing. We've looked before at the NFIB Small Business Optimism Index. We include here as well one called the CEO Confidence Index. And, the punchline here is that in recent periods, there was sort of a move up in the wake of the election, this idea of a business-friendly administration, and things have moved back down, but still at or above sort of the long-term neutral level, right? So it's sort of like maybe not pessimistic, but certainly not as optimistic as right after the election. So that's another sort of soft data point that we're watching, is how are business leaders feeling, and how do we see that translating to investment? We've talked a lot about inflation. Basically, inflation had heated up in the most recent months, a little bit above the Fed's 2% target, is represented by the green line here. The most recent print, thankfully, in a pretty good spot. CPI really close to that line, and PPI actually down closer to zero. So, we've got to see more data, but there's a decent chance we'll see inflation start to cool a little bit relative to where it's been in the last few months. And of course, another sort of soft data point is going back to that same consumer base and asking them, where is inflation going to be over the next 5 years? This is even more dramatic, right? When we look at the Republicans' response, sort of the mindset is everything's good and inflation's going to fall like a rock down just above 1% over the next 5 years on average. Whereas the Democrats are really spooked about it. And so the number's super high. And again, they blend together to have what looks like an overall data point that's a little bit high. But again, I think that idea of sort of a partisan view is pretty important. And again, something about the data that we'll keep an eye on very closely. In any event, the Fed actually met recently here for their March meeting. They kept their Fed funds rate unchanged. They did slow the pace of their balance sheet reduction a little bit. But basically, they came out with their summary of economic projections. They're forecasting by the median forecast 2 quarter-point cuts later this year, 2 next year. That's reasonably in line with the Fed funds futures. And that's a little bit more than might have been thought of a while ago. And again, that relates to the fact that we're in a period of uncertainty, and the market is sort of signaling that investors in particular are worried about that. So I think that the recognition is that there's going to be a point here at which the Fed probably has to step in and act to kind of keep things in a good spot. In any event, as we've talked about before, we've got all the data that we sort of observe when it comes to the fiscal trajectory of the country, especially the federal government. We know rates are high. We know debt is high. We know the cost of our debt is now about a third of our discretionary budget. And of course, as the officials in the administration have come in, we're seeing people talk a lot about this really across the administration. So it's in focus. And even though it's going to be rough, we think it's super important that it's in focus. It's an issue that needs to be wrestled with and kind of overcome in our view. So anyway, as it relates to the economic forecasts overall, I mentioned that the Fed issued its summary of economic projections. They've softened their forecast for 2025 and 2026 to 1.7% and 1.8% respectively for their GDP forecast, that median from their officials' projections. And as I've alluded to, that's a little bit softer than the consensus expectation. But honestly, what's interesting about consensus is that there's a lag, right? Every economist that contributes to that has to be processing what's going on. And inevitably, what we should expect to see in the coming months is basically those economists sort of softening their growth forecast for this year and next. And so we're going to expect that consensus number to come down. But the key and important takeaway, in my view, is that these numbers are all positive. And so there's a view that essentially will have continued positive economic growth, just not quite as much as what we saw last year. And again, to take it back to my comment a moment ago, our outlook for the year was for modestly positive growth, but not as good as last year. So again, we'll see how things unfold. But right now, the Fed and the data more generally isn't signaling a recession. So let's get into the markets. We've talked a lot about higher interest rates. So the interest rate environment remains elevated, certainly relative to the lows that we've seen in recent years. And what I would say is the curve, again, is starting to be more normally shaped, meaning the short end of the curve, shorter maturities are generally speaking lower than longer maturities. That's sort of a healthy sign. What that means when it comes to the bond market is there's a lot of different sectors you can consider for investing money in fixed income and earn a pretty good yield on those investments. Now, when we turn to the equity market, I mentioned that we'd seen a downturn, but interestingly, when it comes to that cap-weighted S&P 500, we're still a little bit richly valued when we look at price-earnings ratio. So 11% overvalued. But we've talked about a broadening of the market. So when we look at the equal weighted index, basically on average, stocks are sitting at a discount. And so, we've talked a lot about the idea of investing in a more diversified way, an idea of the market broadening out, and the data continues to show us that. Now, part of that is triggered by what has been very, very strong performance looking back last year and the year prior from that Magnificent Seven stocks. And as we talked about over the last few sessions, investors and analysts, really Wall Street analysts, have been expecting a high earnings growth from the Magnificent Seven in the coming years. But the reality is those forecasts have started to decline to a point where the earnings growth is approaching the rest of the market on average, and that of the rest of the market on average. And so when we look at the price earnings ratio of the Mag 7 versus the rest of the market, and we calculate that PEG ratio, the punchline is the Magnificent Seven has been a little bit overvalued. And so we should expect a broadening, that other areas of the market can sort of rise up and outperform the Magnificent Seven stocks, for example. And in fact, when we look at the data so far, that kind of plays out. So I draw your attention probably to the 2025 year to date. And you can see the S&P 500 down a little over 4%, the equal weighted index down less than 1%. So that, on a relative performance basis, is the market broadening out. We see things like high quality companies performing better, actually posting positive returns, value stocks which have been out of favor, posting a positive return, and then the growth side of things, really led by the Magnificent Seven, generally speaking, posting more negative results. And so this kind of thing happens, right, where the parts of the market come and go. And the punchline here is that diversification and a broadening of an investment strategy has ended up holding up well in this generally negative environment to start the year. In fact, notably, you'll see the performance from non-U.S. indices like the EFA index. Those are developed markets, and then the emerging market index. Both of them, year to date, very positive numbers. So again, being diversified is a good thing. Now, looking forward, as we always do, I'll just remind folks that so much of the work we do is anchored in our long-term themes. We're going to be watching when it comes to the activity in DC and how that might affect policy, that might affect themes. Artificial intelligence is a big part of this for sure. And so, if there's new regulation or ways to think about AI under this new administration, we'll have all eyes on that. And then in a more straightforward way, we're going to continue to watch the data where we've talked about soft data, right? Some things that are more survey-based signaling negativity. What we have to watch for is to the degree that negativity makes its way into the hard data, what's actually happening with the economy. So that's what will continue to be in focus as we look forward. I'll just close by inviting you, as I always do, to check out stifelinsights.com. All this work is produced for you that we host there. Thanks so much for watching this session, and we'll see you next month.